first rates. Are we in for another good day of trade? Well, our technical experts have been endorsing that, so it's a good start, and let's look at that. The market breadth, touch wood, phenomenally better than what we've seen. 1:14 is almost like a dream market breadth. You've seen this really when markets are in a very strong, bullish groove. The small cap index adds another percent. Larsen, Axis Bank, Tata Steel, Bajaj Finance, Indices. Has the elephant started dancing? Well, it's taken the first step in the right direction. You guessed it. No, it's HDFC Bank now. We're changing the definition. It's HDFC Bank post the numbers. 14%, 21 rupees, 14% weightage, 21 rupees higher for HDFC Bank post numbers. Let's look at now Reliance. And especially Geo Financials, because the first number of the listed entity are out. Operationally there is nothing in the company, so the other income is a function of dividend income and other investments what they have. But it's a neat start. I will not say it's a great start or a subdued start. It's a neat start for Geo Financials, and it's a good start for Bajaj Finance as well.
And good start for SEAT as well. That stock is holding with a gain of around 8 to 9%. Ditto can be said for KEC, which is trending higher by 5% on account of that 1300 crore order win. Result reaction coming in for ICICI Securities, 4% higher. Bank of Maharashtra, some follow-up moves from yesterday. So 3% gain, Data Patterns, Jamna Auto, Karur Vysya Bank. These are some of the other names. SEAT, of course, surprised with that margin performance, and you're seeing a rub-off impact on other tyre companies. Apollo Tyres and MRF, these are the other two counters which are surging in the trading session. You also have Cyient DLM, which is reacting to its earnings, so watch out for that one as well. On the losing side, not many names, to be honest, from the frontline large mid-cap names. It's KPIT Tech, which is a bit under pressure. Emphasis is the other one that we are watching out for. And then, of course, some of those fertilizer names are retreating. So FACT, etc., seeing some consolidation and profit booking. But it's clearly PSU banking space, which is leading from the front. And then metals, that solid rally that we saw for almost 1% yesterday is seeing some build on gains. So names like NMDC, Jindal Stainless, Welspun Corp, Nalco, Hindustan Copper. These are the names which are surging in the trading session.
Let's check in on Bajaj Finance as well ahead of its numbers, and they're looking to acquire the 20% stake in Pennant Technologies. It's an all-cash deal. Although, looking at the base of Bajaj Finance, it's a minuscule one. 267 crore rupees is the fund used. There's also Delta Corp. While, of course, the stock gapped down yesterday itself, but details on the block deals. Bank of America has sold 30 lakh shares, as has Society Generale sold about 13.5 lakh shares. Delta Corp is finally seeing a bit of a bounce. In fact, we're going to be chatting with the management as well in the due course of the show today. So make sure to tune into that particular conversation. But that's pretty much it. There's Piramal Pharma. They've launched in vitro bio capabilities at one of their services site. So that's another stock which is going to be in focus. Grasim, wherein the board has approved a 4,000 crore rupee fundraise via rights issue. That stock is holding up 1%. A decent move actually on Piramal Pharma as we speak. And then, of course, let's check in on the high flyers from yesterday. Hero MotoCorp, GNFC, MCX, NMDC. They were all holding up in trade yesterday, as is the case today as well. So not bad actually, Kunal. It's HDFC Bank which is supporting the index.
Yeah, it's a good start for the index. We are back again about the 90,800 mark. So hopefully this, if we sustain about this level throughout the day, then I think it could be a breakout for the index after this consolidation. In terms of the opening trade, I will pick a differentiated name, ECC, something which looks attractive on the charts. The stock is trading about the 50-day moving average, and we've seen many of the cement stocks actually going to a strong recovery. So we'll pick that stock.
Okay, Naresh, what are the first trades that you're punching in?
So continue to like Ipca Labs. The stock is setting up for a breakout above a 950, 960 mark, could head up towards 1050. So like that one.
Aman Chauhan joins us now. Let's take a conversation forward and understand that where Abacus Asset Management is investing and what is the current view of the market is. Aman, great to have you back. Thank you for joining us. When I speak to some of the common friends, they are saying that it's a gold rush time right now for your investors. The gains are like never before, flows are like never before. वो हिंदी में कहते हैं ना कि सोने पे सुहागा वैसा समय चल रहा है. Is it true?
Partially true, yeah, good inflows. But the problem is everybody is chasing the past returns. Everybody is seeing last 6 months returns or the last 2-3 years return and coming in. But overall, it's definitely good times. good markets, good flows, and economy is doing fine. So all well as of now.
So where are you investing right now, Maman? Given that you have a compulsion to invest and if you're getting fresh inflows, where is margin of safety and where are you picking your spots?
The financials have not performed in the last 6 months or so. So that is something where there's still some margin of safety and incremental liquidity can get deployed because these are very liquid names. That is something definitely that we are looking at. We are selectively deployed some cash into some of the recent IPOs over the last 2 months. So that is one segment. Some bit of metals also. So we have 2 or 3 metal names into our portfolio. So incrementally, we are further deploying cash into these names. EPC is looking good. Quasi real estate plays like, say, laminate companies, cement companies, MDF companies, tiles. So this is something where we are pretty positive on. So that is where bulk of the consumer money has gone in the last 2 months.
And where are you doing the reverse, which is where are you booking some profits? I remember you bought into companies like Tesmaco, you bought into Titagar or Tesmaco, I don't remember, but one of the railway companies, Titagar you bought into, you bought a lot into mid-tier banks, your investments in companies like Route Mobile. Have you locked some gains there?
No, as you said, the inflows are on, so there is no hurry to lock profit there unless valuations are got out of sync. So we have an internal rule that single stock doesn't exceed 10% of the portfolio. So wherever stock holding has gone beyond 8 or 9%, there we have booked profits. So we are cautious on chemicals because we feel next 1-2 quarters there'll still be some margin pressure. So very selective on the chemicals front. We are neutral on IT. We are not sold anything, but haven't bought anything incremental either. So these 2 segments we are pretty, can say, neutral on. Besides that, it's more of a stock-specific scene rather than taking a sectoral call.
What's the overall market view, Aman? Because while we have geopolitical uncertainty on one hand, but on the other, I think the bigger dominating factor is the volatility in the US yield of late, albeit at elevated levels. And of course, I guess the another key risk is going to become next month. You will step into state elections as well. So is there a tactical positioning that you take at this current macro environment?
Yeah, so we are, I'll not say bearish, but we are definitely cautious. So we have stopped buying new names into the portfolios, very selectively adding new names. Anybody who comes into our PMS would getting deployed only 70 to 80%. So we are keeping tactical cash of 10-20% and gradually deploying it over the next 1 to 2 months. So that's the broad plan. So we're not completely deploying the money that we are getting in for the same reasons as you mentioned. Frankly, markets have been surprisingly positive. 2 weeks back, we were also worried for the same US yields as well as oil moving up. Market took a breather, but then again, the side markets or the mid caps continue to rally. So it's showing amazing strength, predominantly maybe because of the liquidity coming in. But overall, if I have to take next 3-6 months view, I'm neutral in the markets, right? So no big hurry to invest. At the same time, not keeping cash. That I don't expect markets to crash down. Profit booking can definitely come in, and that's what we are hoping and waiting for to deploy further cash.
Sure, Aman. And we were discussing the entire, the argument whether the elephant will dance or not. And we're talking about the elephant HDFC Bank. That's doing all right now. But I'm looking at your top large cap picks from the banking space, and ICICI Bank features on the list. Preferring ICICI Bank over HDFC Bank, or are you looking at changing that view a bit?
For now, we're sticking to what we own. But having said that, HDFC Bank definitely is looking attractive. We are, for the first time, started to look at it. We never have owned it over the last 4-5 years now. But at 15p FY25 earnings, what the consensus earnings is, there's definitely value and there's definitely merit to look at HDFC Bank.
Aman, now the current quarter is not great for IT, but looking at the order book, what they've indicated, purely the deep deal pipeline, looks like FY25 will be a big comeback year for them. And maybe that is the reason why IT stocks have not fallen flat despite disappointing set of numbers. Is there a valid view in assuming that next 6 months tough for IT, but next 12 months or next 18 months could be great?
Yes, we have the same view. That's the reason we have not sold or reduced our IT exposure. We are holding on to what we have. So next 2-3 quarters are not going to be great. But the way people look at IT is sequential growth. So fine. Then we're heading for the December quarter, which is a seasonally because of holidays a weak quarter. Post which the sequential rates can pick up, and then the stocks can continue to perform. So that's broadly what my view also is on IT.
So Aman, I'm going to change gears and talk about metals. Now, you've been liking metals for a while now. Sunil has been communicating the same. My follow-up question is that for metals, the picture is mixed. China, we don't know what's happening. US pleasantly surprises us. In the light of geopolitical tensions, China the unknown factor, and US surprise comeback, does it make sense to buy into any global commodity at all?
Frankly, the global uncertainty is there for all global stocks, not just commodities, because we know for sure that Europe is slowed down, US is slowing down, rates are pretty high in US, demand is lower. So not just commodities, like exports of textiles has also slowed down from India, though we are gaining market share. So globally, demand is slow, and which is true for the metal stocks also. And that's the reason we don't have a very high exposure. We like it, but it's a single-digit exposure into the portfolio. And for the same reason as you mentioned, that it's a global commodity, you need to be very clear as to why you're getting into a certain stock. So the stocks that we own all have, I can say, individual merit rather than just global prices. So we don't own the obvious names like a Tesco or a kind of names, but we have stocks where either there is debt restructuring, there is new capacity coming up, new mines getting operational, some benefit coming in for us to look at these names and invest into them.
I don't see a lot of auto names in your portfolio. Maybe I'm just missing out on that. But any of the two-wheeler or four-wheeler names that you like today, of course, all the tire stocks are doing cartwheels. The likes of JK Tire, that's up almost 9-10%. Seat is doing quite well. Is there any name that you would want to bet on or like, at least in the auto space?
So we have always been, can say, underweight on auto, and for a reason that we find the global auto names which trade as single P much more attractive than paying a very high premium in India for companies which are not even prepared for the EV the way global players are. Having said that, stocks have done well. It's a bull market. All sectors have contributed to the rally, including auto. So, but for now, we would like to continue to maintain our strengths. We have some auto ancillary names in the portfolio, but not the real auto names, both on the two-wheeler as well as on the four-wheeler side.
Aman, how is it that you're playing this entire renewable energy theme right now? Because that seems to be quite the dominant and upcoming one.
It is, but unfortunately not many names where we can invest, and the ones that are there, either the valuation is not what we are seeking for, or there's some issues here and there. So not much of EV exposure, or you can say renewable exposure to the portfolio. We like the theme. It's an obvious sector that one should be looking forward to, but unfortunately, not much of exposure to the portfolio.
There is a massive re-rating in PSUs, whether it's defense, whether it is railways, or whether it is perhaps to some extent even construction PSUs. 10 years ago, or let's say 3 years ago, PSU stocks were the official ugly ducklings. Nobody wanted to buy them. But now, irrespective of what business you are in, as long as you're a PSU, the stocks are going higher. How are you approaching this space?
We are constantly staying away out of this. We know for sure that that's where the momentum right now is, but happy with what we own. So we own some of the large PSU banks. Beyond that, not much on the defense side. We have some 1 or 2 private companies on the defense side, but none of the defense PSUs. In hindsight, it was a tactical trade, but since we don't do more of tactical investment, we invest the 3 to 4 year horizon. For now, very little of the mid-sized PSU exposure, both on the banking and the non-banking side, where right now the momentum is. So at least on the portfolio front, I can say not much of exposure into these names.
If one has to look at market starting from here to, let's say, next year, there is an election cycle. First, there is a state election cycle, then there is a central election cycle, and same time next year there would be a US election cycle. Are we in for linear returns? Are we in for no returns? Are we in for volatile returns? Because we may not like it, but we may not, whether it's right or wrong, election cycles can be swing events.
I think there's a high chance for volatile returns. First, the state elections could disappoint, but then people will start looking at the last time also this had happened when BJP didn't do that great in state, but when it came to the center, people voted for Modi. So it's the same theme will go for the re-election next year for Modi. We are all hoping the government comes back. If that happens, India is in great shape and markets will take it very positively. Both local as well as global investors would like the current government to continue. And if that is the scenario, then Indian equity markets are headed for good times. And in US also, prior to the elections, I don't see any major fall or correction in the markets. The central banks there will come in case there is some crisis that they came in for CSRB crisis. And hence, for the next 6-9 months till the US elections also, I expect global markets to be stable. There can be near-term volatility, but nothing scary in a way.
On that note, Aman, we let you go on that positive note that there could not be anything much scary, at least in the global market. Steady is what you're expecting the next few months to really pan out. Thanks so much for joining us today. But of course, the space which is doing very well for itself is the entire tire basket, whether it's a JK Tire, an MRF, CEAT, of course, on account of its earning. All of these stocks are up and away. In fact, let's discuss the a stellar performance that we have seen from CEAT this time, especially on the margin front with Arnab Banerjee, the MD and CEO at CEAT, joins us on the show. Arnab, hi, good morning. Thanks so much for making time and speaking with ET Now. Let's begin by discussing the margin picture itself. EBITDA margin at 15%, almost doubling year on year. Gross margin almost 43%. Is this sustainable?
Yeah, it's been a very good quarter for us, especially at the gross margin level. As I had been talking about margins, we want to maintain our margins in a narrow band going forward. So our objective is to have predictability of margins, stability of margins, and gradual improvement. So I think if there's no great volatility in the system, we would try to maintain margin in a very narrow band.
That'll be easy to do that, Arnab, given that crude prices have moved up. So I'm guessing the next quarter, the RM basket cost will also escalate.
Yes, crude has gone up and imported rubber prices have also inched up. But at the same time, demand for tires are weak in China, in Europe. So these two things will balance each other out. But you're right, the raw material basket seems to have bottomed out. And there'll be a gradual creeping inflation going forward in Q3 and Q4.
When you say that, you'll try and maintain the margins in a narrow band, and you talked about the volatility in the raw material prices, what could be that narrow band, both in terms of EBITDA as well as the gross margins?
See, when I meant a narrow band, in the sense we don't shift the plans quarter on quarter. We had been continuously focusing on the larger profit pools, which is our two-wheeler business, our four-wheeler business, and now an increasing share of agriculture radials, both mostly in international business. The proportion of this business is gradually increasing quarter on quarter. That's number one. Number two is that we are improving the relative positioning of our products in the market. For example, in Q2, there were a lot of action, but our relative price positioning in both passenger and truck bus radial has improved in the market. So we are not, behaving like a typical commodity player moving up or down with the basket. We're trying to improve the mix and the margin profile so that we can adjust to moderate swings in raw material prices.
Okay. So can I say that 13 to 15% is the new normal for you?
I wish it is, but you can take any number. But as I said, we don't want to go back to 10, and 20% is also unlikely.
Okay. How much of your demand currently is a function of replacement market?
Replacement is critical for us. Replacement and international, both are important. International business is, in fact, EBITDA accretive for the organization. Between these two, about 70% is the contribution to the overall basket. About 30% is OEM sales.
Okay. Could you give me a split of your revenue, two-wheelers, CV, car, and EV now?
About maybe it's about 1/3, 2/3. 1/3 is truck and 2/3 is non-truck overall, and volume wise. And within that 2/3, an increasing component is the agri-radials, which is coming up to agri-radials and farm, which is coming up to almost 16-17%. The rest will be passenger.
What is more lucrative for you? Stick to trucks or expand back to PV and CVs? PVs and
We are
EVs.
market leaders in replacement in two-wheeler, as you know, so that's important business for us, and we want to consolidate there. Last quarter has been very good for two-wheeler business in aftermarket. The OEM sales in two-wheeler September was good, but yet to recover to pre-COVID levels. Passenger, we are it's a very tightly contested market share-wise. We intend to be market leaders in passenger, in aftermarket, and also investing lots in the electric vehicle phenomenon, four-wheelers and two-wheelers. For us, passenger side and agriculture for international business are the larger profit pools that we're chasing. We are also have a decent presence in truck bus radial, but most of the margins will come from non-truck.
Sorry to come back to the point of margin again, Arnab, but I just wanted to get a sense from you. Do you think that 15% what you've delivered this time is the peak of the margin, at least for the next 6 months?
I wouldn't know. It depends on how things play out on the raw material front and how we manage our product mix and pricing. But all I can say is that our margins, we are trying to manage our margins in a very narrow band, which I had stated earlier.
Sure, a word on the balance sheet as well, because your capex plan continue, at 170 crore, I think, in the quarter gone by. What's the plan to reduce the debt going forward? I think it's almost 2,300 crores right now on the books.
No, we have reduced our debt significantly in quarter one vis-a-vis quarter four of last year by 100 crores. Again, quarter two and quarter one, 100 crore debt reduction. So we have come down to about 1850 odd levels now, which is quite comfortable. Our debt EBITDA ratio is very comfortable, just around 1, which is very, very comfortable. So, our current year capex guidance has been, for the whole year, has been 750 crores. It might look up to around 800 crores at best. So mostly stable capex plan, and we intend to have bite-sized capex every year so that we can maintain the financial prudence while growing.
You know, when you talk about your vision FY26, and a pretty interesting there, that you're aiming to double your export revenues from the current 2,000. How do you plan to achieve that? What's the roadmap looking like?
There are some key geographies that we have identified. For example, Europe is one of them. And there are specific plans for product launches in this market in agri-radial, in passenger vehicle tires, and in truck bus radial tires. Our passenger vehicle tire, in a very prestigious German magazine rating, Auto Bild, has featured 15th out of the top 35 brands in the world, and it is the only Indian brand to have featured in that prestigious list. And customers in Germany go by magazine rating. So we are investing a lot in marketing. We are going to launch our products, passenger and truck bus radial, in the US by quarter four of this year or quarter one of next year. Latin America is another focus geography. So there are specific product market plans, local sales team, local customer insights, local product development, and local marketing, of course. So we are quite bullish about our international business plans.
Will there be a proportionate level of crude which you can share with us, at which crude will start hurting you and you will be forced to increase prices? What's that? What is the sweet spot for you, and what is the gray area for you?
See, the entire basket is what matters. So crude is one variable which impacts synthetic rubber, the nylon tire cord, and carbon black kind of thing. Then there's natural rubber, and the whole basket doesn't move up together. So right now crude is around 90-ish. If it stays around that or below, I think it's okay.
90 or below is something which you are able to manage. I just wanted to come back to the question of the international geographies, and I'm a bit confused because initially in your comments you did say that demand from Europe and China is weak, and of course you're talking about it in terms of the potential of it as well. When do you expect the recovery in the international markets? Is the demand weak or is it holding up okay?
See, for us, where we have a significant presence, for example, agri-radial in Europe, the recession in Europe will have an impact, and it does have an impact. Where we are starting out and the market is huge and we have very low share, like in passenger radials or truck bus radial, the recession in Europe, it doesn't really impact us, and we are growing handsomely in Europe. Then there is US, of course, which is not in a recession, which is doing well, and we're going to launch the products there. So it will have some impact, but it's not a huge impact vis-a-vis our ambitious growth plan of 2x by FY26.
Okay, on that note, Arnav, we let you go. Really appreciate you joining us and candidly speaking about the outlook as well. So, of course, margin is something that they would want to hold on to and maintain in a steady range. But let's see where it goes from here. The stock has given up some of its gain. It's still holding up with 7% gains, but off the highest point of the trading session. Quickly, let's pull up the other names as well. MRF, JK Tyres, Apollo Tyres, and see if there is a bit of an impact there as well. So MRF holding up with a gain of around 3%, JK Tyre flying away with 10% gain, and then Apollo Tyres too holding up comfortably in the green. Let's slip into a very short break, but don't go anywhere.
Back with first trades right here in ET now, and let's just see what the first trades have settled in at. Well, to kickstart, of course, it was HDFC Bank which got the Nifty that much desired leg up. We're still holding on to that 0.5% gain. HDFC Bank still a winner today. There's Bajaj Finance as well, which has climbed up a good 1% ahead of its numbers. But, you know, we were just chatting with Siet. Look what MRF is up to. A solid 3.5% move is what you're seeing on MRF. A very steady mover. In fact, it's one of the top movers today within the F&O markets. There's also Apollo Tyres looking very strong, a 3% move coming in there. Delta Corp after those two sizable block deals. Today it's making a bit of a move. L&T Finance up 3% and ABFRL for a second consecutive day on the trot this week, holding up 2.5% as we speak right now. But the Indian aviation industry is in its golden decade. That's the word coming in from Vinay Dubey, the CEO at Akasa Air, who believes so. Let's hear out his interaction with Nikunj.
We are back squarely in growth mode. So if you look at what we're flying today and you compare it with the network we have published, exiting this financial year, there's almost a 30% growth. And that growth is reflective of two factors. One is our planning and training related to pilots, and the other one is the delivery of aircraft.
How will you ensure that this problem is avoided? Because looking at the numbers which we are getting from, let's say, Indigo or from Tata's, we are looking at the sector almost doubling in 6 to 7 years, which means suddenly there could be more aircrafts and less pilots.
So I'd say a few things. First, I think it's all been clarified now, by the courts, by the regulator, that pilots have to serve their notice period. So we're not looking at any more resignations for us or anybody else in the industry with 24 hours notice. Now it's a minimum of 6 months notice. So that's just to give everyone a sense that stability is here to stay for the entire industry.
Now looking at the fact that the sector could double up, whether it is 5, 6 or 7 is what we are debating, but directionally we are headed there. You're confident on the pilot side, but what about the back end? What about the maintenance? What about the availability of parking bays? What about the simple maintenance fleet? Is that everything in place for the Indian aviation sector?
Yeah, I think in place and more. So you can start with terminal capacity and parking bays and airports. And our government has just done a phenomenal job in terms of building airport capacity. Just right off the bat, you've got Navi Mumbai. You look at what's happening in Bengaluru, Noida, Chennai. You take any airport, any state, and the government has ensured that we're building aviation capacity. So we're in a very, very exciting phase. You talked about maintenance. Not an issue because some maintenance is done here. But for us, for example, our engine maintenance is done by the OEM. So CFM is what we've signed a long-term contract with for our engine maintenance. So I don't foresee that as being, an issue at all. I think we're in a very exciting phase. For me, it's the golden decade for aviation here and for airlines in particular in India.
When you say Akasa is back in growth mode, how would you define that?
So I'd say, look at the network we published for March. It's about 30% larger than it was today. So what happened was we grew very, very rapidly from 0 to 20 aircraft. All planned, to ensure that we actually get qualified for international operations, which we were and did, and we can talk about that. And then we decided to take a planned break of about 6 months in delivery to help us prepare to launch international operations and then start taking deliveries again. So our next 2 aircraft will be delivered in December. This is something that we'd planned way back in 2021. Again, we are a team of planners. We are aviation nerds. This is what we do. This is what we've done all our lives. And so when I say back in growth mode, it's our deliveries will start and our growth will start once again. And statistically, like I said, if you look at our network exit March, we're 30% larger than what we are today.
If I look at the numbers, 20 becomes 25 and 25 becomes 100, 100 becomes 500. You're looking at least a 15 to 20 times jump in your fleet capacity. That's an ambitious number. How would you reach there?
So we reach that step by step, aircraft by aircraft, delivery by delivery, one satisfied customer by one satisfied customer. First, the number 500 is not quite in our horizon. We can see till 200, 250.
That's still 10 times.
That is. But remember, we've got a small base. We've placed an order already for 76 aircraft that deliver through 2027. Within the next 65 to 85 days, we'll place a much larger order, which will see us through 2032. So our horizon now is set till 2032. And this happens just by good planning. There's no secret to it. You have to roll your sleeves up and you have to plan day by day. You have to plan aircraft by aircraft, employee by employee, facility by facility. But this is not a problem. And the reason it's not a problem is because we've got an insatiable appetite for aviation demand in India. Just think about it. We've got 650 aircraft flying in India. That is about half of one airline in the US. That's how small we are, and we have a population that's 4 or 5 times the US. Another statistic, in the last 25 years, India added about 450 aircraft. In the last 25 years, we added 350 million passengers, or million in terms of population. So, for the foreseeable future, next 20 years, we've got this massive demand growth. And so, my view is no matter what, supply numbers and aircraft numbers you're looking at, demand is going to completely outpace supply.
You've reported a loss of 700 crore for FY23. Can I say that is the cost of launching an airline? We should not read too much into it?
Well, you absolutely shouldn't. It's the early days, that's the cost of launching an airline, but it's not even the cost because that's the P&L. If you look at, if you were to use the word cost of launching the airline, you'd think we might have burned through, 1 rupee or more of our initial investment. But we are, free cash flow positive.
Is it?
We're free cash flow positive. So we started with an initial investment and we've just added to our reserves. And this is at the time where you'd expect the largest cash burn. So I'd say for any business, but more so aviation, the P&L and the financial health of the business are completely disassociated for the first 5-6 years of the business. So I wouldn't read anything into it at all. I think what you need to look at is our cash position today and the fact that we're generating free cash.
So before the entire fiasco on the pilot front happened, you were flying and you were flying almost in triple digit on a daily basis. Have you gone back to your number in terms of normalizing?
We're flying triple digit departures. There's no question about that. And in the first 11 months, not only were we the fastest growing airline in the 120-year history of aviation, but we were also India's most on-time airline with the lowest cancellation rates and the most dependable airline. And I'd say we're back in that mode. We're back in growth mode. We're back in terms of, offering a very, very dependable network with being one of India's most on-time airlines.
And how soon do you think this triple-digit departure rate will become four-digit departure rate?
It's going to take us a little while. That's a 10x. It's going to take us a little while, for us to fly over 1,000 flights a day. We're a few years away.
But that'll be faster than your capacity of fleet addition, because you will be able to sweat your assets more, I would imagine.
You can, but for us, offering a dependable service is more important than chasing market share or squeezing the last drop out of utilization. There is a balance here. There's no point, flying a lot more than you actually can fly and the customers suffer for it. That's never been our philosophy. And again, if you look back historically, we've taken great pride in being India's most on-time airline for the first 11 months of our operation. So it's going to take us a few years to get to 1,000 departures. But we're not in the market share game. We're in the business of growing profitably with happy and satisfied customers and employees.
So FY23 was all about launch. FY23 and FY24 could be about dealing with typical birth problems, if I may use the word, getting the house in order. FY24, FY25 is when you will start adding more capacity, start adding more routes.
That's correct.
Walk us through that. How will next year be different from this year?
Well, for one, in terms of aircraft, we should end, March of 2025 with a fleet that is double of what we have today.
So 20 becomes 40.
Approximately, that's correct. We will also launch international. So we've just got what we think are extremely, juicy, financially lucrative routes that have been assigned.
Now, which is the first one you'll fly?
Well, I wouldn't focus on the first one because we've got assigned 5 or 6 routes for us, in terms of Riyadh, Jeddah, Doha, Kuwait, which are all, money spinners for airlines around the world.
These are not code sharing. These are independent.
No, these are independent Akasa flights, Akasa metal, as they say. Very, very exciting for us, right? And so you should see in FY25 not just the growth, but a considerable amount of international growth, Nikunj. That's extremely exciting because that growth comes with much higher profits than even domestic flying today.
The landscape of the Indian aviation sector is going to be changing soon. Akasa is growing and Air India has taken a rebirth because of Tata's. Do you think there could be a price war in the skies now?
Not at all.
Why are you saying this confidently?
I'm saying this confidently. Just look at what happened, 1 week ago, in terms of, one of the more dominant players coming out with the pricing structure that they did. So I'm saying that just based on historical information. I don't even need to forecast 1 or 2 or 3 months in the future. But the other thing, which is more important, is that we've got a leading cost structure. So Akasa is one of the most efficient airlines in the world, I'd say, with one of the best cost structures. So no matter what twists and turns the industry is going to throw at us, we're extremely well positioned to be able to get through them. So this doesn't bother us.
Everyone is complaining that for the cricket match to Ahmedabad, whether it was Delhi to Mumbai or Mumbai to Ahmedabad, airlines, they charged a hell lot.
I am focused on India's victory. You worry about the rest. I am just focused on the amazing 3 victories that we have. I couldn't be more excited. I think we're going to win the World Cup. I always do. I am just a huge, huge, huge supporter of this Indian cricket team.
Both of us, I'm sure that we've seen, I've seen it, I'm sure you must have also seen it, the famous movie Wall Street.
Yes.
Corin Gecko. The punchline of that movie is, every man is chasing a number. What is that number for Vinay Dubey?
Well, actually, we're not chasing a number. I have a math degree. My master's is in applied math, so that's a fitting question. But we're not chasing a number. We're chasing long-term, durable profitability. I mean, what I tell people that I see, we want to create an airline where our collective grandchildren will fly on. So we're chasing long-term profitability with happy customers. right? That's what we're chasing.
I'm sure you got happy investors also. I mean, the fact that you're operating cash flow positive, which is incredible, which is what investors look at. What's been your communication with, let's say, Madhav or from the, Rare family office? They are two large investors of yours.
So we talk to them all the time. First, I'll say, they're an amazing set of investors. We couldn't be happier with them. But we're a board-run company. We're very close. It's a small group of people. It's not a large group of people. And so we're in constant communication with them. And it's absolutely wonderful.
I remember it was on the Economic Times podcast. You said the following, that thank you to Mr. Rakesh Jhunjhunwala, Akasa is in existence. He's a man with vision. Do you miss him? It's been a year now.
Absolutely and unequivocally. I certainly do. Many of us, from a business perspective, they do. But, let us not compare how we miss him to how his family misses him. I mean, let's just separate the two, but we do. I do. I absolutely do.
He was a mentor and great friend. So all of us miss him per se as a friend and as a guide for markets also. Final question, if you have to board on an emergency route and unfortunately Akasa does not fly, so what would be the choice of the next airline for you?
That's something you have to answer. I would just say, come try our seats out, come try our food out, and you won't be disappointed.
Back with the market right here in ET. Now, it's the tire names, not just Seat, which of course, set out a blowout set of numbers, but MRF, Apollo Tires, the entire pack is holding out just very smartly. MRF, one amongst the top movers today, over a 3% move, 11,300 is where that stock is right now. There's Apollo Tires as well, which is holding up by about almost 3% as we speak. And the Nifty as well going very strong. That 0.5% uptick stays. We're around that 19,850 print on the Nifty futures. But let's welcome on board Suniti Bhatt, the MD at Ceylon Exploration Technology, to talk about how their quarter has been and where they see things going forward as well. Suniti, great to have you on the show. Just wanted to understand in the second quarter, your average production was about 681. But given that most of your wells started producing somewhere during Q2 and were not operational throughout, wanted to understand what's the current production rate and where do you see that headed in the next few quarters?
First of all, thank you for having me here. And yes, we had a good quarter. As of now, we pretty much got the production uptick sometime in the middle of the quarter. As of today, our production is to the north of 750 barrels coming from various wells. We still do not have all the wells fully contributing, as we have come out and said. The key field, which is Bakrol, we still sometime in the middle of November are going to frack a couple more wells. And towards the end of next quarter, we should see the full impact of the development campaign that we had started out sometime at the beginning of this quarter. So we expect that we will stay within the guidance that we had given the market when we started the drilling campaign, that will be somewhere between 750 to 1,200 barrels. So we're still pretty confident that we should be within that range somewhere.
Real big breakout production year come for you. Will it be FY26 or beyond that?
I think for us, I think we also announced a merger with our other group company called Antilopus. I think for us, the next few years will be about production growth. We are really looking at growing our production volumes, both from the Ceylon assets and in case the shareholders approve a merger through the Antilopus assets also. So I think for us, the idea is to create a mid-sized oil and gas company as we go forward in the next fiscal and the fiscal after that.
Your most optimistic case, and please correct me if I'm wrong here, for FY24 was that of 1,200 barrels, right? How confident are you of achieving this and scaling it up higher, perhaps?
I think from the core Lohar, Bakrol and Karjistan fields. I think we have had good positive surprises from the Karjistan field. Bakrol has come out on money. I think Lohar has been a little bit a declining field. We didn't get as much as we expected there. But overall, we think we'll be definitely towards the upper end of the guidance if we will not cross the 1200. But we think this is just the start for us as far as Ceylon oil is concerned. I think the growth years will be the year after and another year as we go through this whole journey of building a credible energy company within India.
Listed entity, which is what we're talking about right now, once post-merger, what will change? Because the numbers what we have for Entelopus Energy, they have oil reserves of 480 million barrels. I mean, that's a huge number.
So I think that I just want to make a correction. I think in our parlance, reserves come in various categories. We have what we call proved plus probable, that is for which the development plans have been approved and all. We have reserves around 50 million barrels. I think what you are quoting there are also discovered resources within our assets, but they are called contingent, for which we have not put in the field development plans. But yes, from a reserves comparison perspective between our onshore Cambay Basin assets and what we have in Antelopus, we do have a robust reserve base that should help us get to a much larger production volume that we have as of today, going forward into the next few years.
Just a follow-up there, because analysts are penciling, given the internal reserves that you talked about at Antelopus, the revenue potential could be around $2.5 to $3 billion over a period of time. How realistic is that number as per you?
I think look, the revenue potential, as pretty much these days we all understand, a big part is always going to be the oil and gas prices, which we don't control. I think because the 50 million barrels out of which 2C reserves are there, I think this is definitely a lot larger than what we have in Ceylon. So I wouldn't like to comment on the 2.5 to 3 billion barrels, but we know that we will definitely have production potential that's an order of magnitude different to what we currently get from Ceylon fields. That is from the Antelopus fields. That much is evident based on the 2P reserves and third-party audit of these reserves and the development plans that are already filed with the regulator.
Equity capital and the share capital of the merged entity, can you throw more light on that? And eventually, where will the equity base move going forward?
I think currently we have engaged advisors, both the boards, both Ceylon as well as Antelopus board. We have engaged advisors to look at what the swap ratio could be, and therefore what the overall share capital for the merged entity would look like. We are hoping that we would come back to both the boards with the recommended swap between Ceylon and Antelopus. And then the board will have to, in their wisdom, look at it and then recommend to shareholders and the stock SEBI as well. But we expect that between Antelopus and Ceylon, we definitely should be able to create a decent size company going forward, both in terms of share capital and the growth potential.
The value, according to you, for the oil reserves of Antelopus, because what you just said in technical terms, the probable and the discovered reserves, we can ascribe a value to it. So is there a value which you can ascribe to it?
I think, look, there are definitely market benchmarks that are out there that can be looked at and you can work out a value to it. But I also want to say is that we use typically dollar per barrel valuation numbers, but a lot of it, the way we look at it is that we are in India. India needs a lot of energy going forward. We have these resources that are discovered within the Indian basins. So therefore, we are sitting on top of commodity that will have need or at least next foreseeable future and is going to do its bit towards growing the economy. So the reason I'm not giving you exact numbers is because to me, that is not what is governing us in terms of how we are looking at it. What is governing us, we want to make sure that irrespective of what the oil price is in short or long term, that we can keep on producing and adding a healthy, adding to the healthy bottom line for all our stakeholders, and also generally producing more oil and gas into our country, which actually relies on imports for energy.
Okay. Now I'm going to ask, let's say, a direct question here. Ceylon Exploration, that's the listed entity. Antilopus, that's a non-listed entity. The merger will happen. So this is 2023, October 2023. 2026 or 2027, October 2027. What should the current listed shareholders of Ceylon expect in terms of a progress, in terms of an value unlocking, in terms of the path to profitability and growth? Because the listed entity, things will change, sir. That's what I think the exciting part of Ceylon now is.
That's correct. I think, let me just dial back a little bit. I think for the shareholders of Ceylon, the way to look at it is, till now, Ceylon has given them exposure into one basin in this country. This country has at least 4 producing basins, or what I call category 1 basins, and multiple category 2 and category 3 basins. With this merger, first thing that will happen is that the shareholders of Ceylon are going to get exposure into multiple basins. All the Ceylon assets are in the Cambay Basin. Antilopus assets, on the other hand, are in the north of KG, both onshore and offshore, in Assam Arkan Basin and the Mumbai High Basin, all of which have been proved to be very prolific basins, similar to what Cambay Basin is. So first of all, it's going to decrease the risk to the shareholders, which is inherent in our business because we have a multi-basin exposure. Second is, it is also increased the amount of reserves that we have in our portfolio. The third is going to be, definitely the shareholders should expect of the management to drive a production growth trajectory, which is an order of magnitude different to where we are today. That is what they should act. So it should be an accretive to the bottom line. It should be an accretive to the market cap. It also should be an accretive to the value creation for all concerned as we go forward over the next 3 years.
We let you go. Appreciate you making time and speaking with ET now. In the meantime, take a look at some of the stocks which are buzzing around on high price volume action. So ICICI Securities, the volumes are already 2 to 3 times the usual average that we have seen. CEAT is seeing quite a bit of trading as well. Data Patterns, KEC, MRF, all of these stocks are trading on high volumes already. A lot of stocks sitting at all-time high level as well. So Kalyan Jewellers features in that list. ITI is up another 7%. Power Grid, Tata Consumer and Polycab. These are some of the names which are sitting at all-time high levels today. But which are the chartbuster ideas coming in from our technical experts? Kunal, you go first.
So that's on Tata Steel, Anisha, and the charts for Tata Steel are at a very interesting juncture because in terms of the risk reward, the placement of the stock, it's at a very attractive point. Now there are 2 important technical patterns which are coming at an confluence for Tata Steel. One is that the stock is coming back towards the 50-day moving average support. So as you can see, the recent charts, the stock has taken support at this red line, which is the 50 DMA for Tata Steel. This historically over the last 3 attempts have been acting as a major support for Tata Steel, and we've seen the stock ending a phase of correction and restarting a strong uptrend for itself. The other pattern to look out for is that this level is not it's not just a price support, but it's also a 61.8% retracement support with respect to the previous starting point for Tata Steel. And this has been the same observation the stock has seen in the last 3 attempts whenever the stock has come back towards the 50-day moving average. So this indicates that this could be a major bottom for Tata Steel, at least over the very near term, and we could be looking at the stock crossing this level of 135 and hopefully kickstarting a metal rally yet again.
Right, Naresh, what's the chart buster that you've identified?
So that's a chart for Indraprasth Gas, IGL. If we look at the stock has been sideways and contracting for the last few weeks. Now it's a classical triangle formation here. 4 attempts done around that 480 mark. Today is the stock has shown momentum also crossing 480, closer to 485, 490. So a breakout done. The next resistance would be 510, 520, which could also be taken out. So a first target of 520. Next would be 600. Stop loss at 470.
Thanks so much for bringing us those ideas. Before I take the stock ideas, the mid-cap ideas and the cracker stocks, let me just mark the news flow on Maruti Suzuki because that stock is reacting. It's pretty much on expected lines, to be honest. We knew that there was going to be a preferential allotment that they're going to make to the parent at SMC, and that's on account of that factory deal that they had done in Gujarat. The total purchase consideration was around 12,841 crore rupees, and the allotment is now happening at a price of around 10,420. It's a smidge below the current market price, and I think that's the reason the stock is taking a bit of a slide as we speak. That stock is down almost 1% in the trading session. We'll wait by and see if there's some incremental negative, because for now it seems on expected line. Maybe the price is something that the street did not like at 10,420, but the fact that the preferential issue is happening was pretty much factored in. Moving on then and getting those mid-cap ideas from our experts. Kunal?
I'll go with two buy calls. Gale as the first stock, which I'll suggest as a buy, trading at 130 plus levels. Can aim for a target of 140, stop loss at 126. And L&T Finance is also a stock which has confirmed a breakout today. So would look out for a buy with a target of 150, stop loss 134.
Naresh, what are your stock recommendations?
So first is a buy in Ipca Labs, the stock near a breakout, stop loss at 950, target price of 1,050. Second is again Gale out here, which is breaking out and showing a lot of relative strength. And the whole gas sector looks interesting. Stop loss at 127, target price of 145.
Right. Okay. On that note, let's take a very quick break while Maruti, of course, is reacting to that known news. It's tires which continue to hold out, as is the case with MRF, Apollo Tires. There's also L&T Finance, Exide, and Delta Corp, which has now moved up 2.5% as we speak. In fact, we'll chat with the management after this break.